Chapter 17, Retirement and Estate Planning. This is the last chapter for the semester. It's also might be the most important for the rest of the semester because your final assignment is to complete a retirement plan. I would highly recommend that you read this chapter and you apply the concepts in this chapter to the preparation of your retirement plan. Comfort retirement plan takes planning. You got to invest early, invest regularly, use tax-sheltered accounts, and diversify. We talked about that in the prior chapters. Diversification is very, very important. You don't want to be tied to very narrow investment categories. Many investors get tied too closely with the stock of the company where they work. It's very easy to do because the companies provide you with incentives to purchase the stock. What is retirement? It's time in life when your major sources of income are changing from earned income to employer-based benefits, savings, investments, Social Security, etc. We're going to talk quite a bit about Social Security retirement benefits. The estate planning comprises the arrangements that you make during your lifetime to administer and distribute your assets when you die. In most cases, that is the distributing your assets to your heirs. We'll talk about different ways where we can do this without going through the courts or through probate. This pie chart shows the average sources of retirement income. We have 24% is down at the bottom is earned income, investment income 36%. Social Security over there is only 20%, and then even less than that is pension and retirement plans. So your 401k is not likely to be sufficient. Your 401k along with your Social Security are not, in most cases, are not sufficient. So we have to think of other ways to supplement our retirement, whether that be through working part-time, other investments, and so forth. There's a lot of thought that has to go into retirement. Your next 5 years related to retirement, save continuously within a tax-sheltered employer-sponsored retirement plan at least the amount required to obtain your full matching contribution from your employer. Hopefully your employer offers one. Some of you may have actual defined benefit pension plans. If you have the opportunity to participate in such a plan, I highly recommend that you do so. They are becoming rarer and rarer in today's world. Your next 5 years, accept enough risk to increase the likelihood that you will have enough money in retirement. Without risk, there is no way that unless you inherit some vast sum of money that you will ever have enough money to retire comfortably. Contribute to, this is Roth IRA accounts to supplement your employer-sponsored plans. I think it's a personal decision. You have to choose on your own whether you think a Roth or a traditional IRA is the most appropriate investment, and I don't think it's a cut and dry decision. I think it's a decision that should be made on an individual by individual basis. Number 4, keep your hands off your retirement money. Do not borrow it. Do not withdraw it. When changing employers, roll over the funds into a new employer plans or a rollover IRA account. It's really easy to do. Typically, sometimes you can go online and do it. Other times you have to fill out forms, so forth. Number 5, to ease the transfer of your assets upon your death, learn how to use contracts to avoid probate. Mentioned this a little bit earlier. Finally make a valid will. The easiest way to avoid probate is by designating beneficiaries on all of your accounts. Learning objective 1, estimate your Social Security retirement income benefit. So, understanding your Social Security retirement income benefits. The FICA taxes that you likely pay every month, with some exceptions. I believe school teachers can choose to participate or not participate, but our public school teachers, the FICA taxes are withheld from your wages. Your employer also matches that contribution, so 6.2% of your wages every month up until I think the $128,700 or something like that. So you're going to pay 6.2% until you get to almost $130,000, which is the maximum yearly earnings. So they're for retirement, disability, and survivor benefits. So they're for your benefit and those of your dependents. Medicare tax, you pay 1.45% of your employment income. There is no cap on Medicare. If you made $10 million a year, you're going to pay 1.45% of that. So, how do you qualify for Social Security benefits? Social Security credits are earned for every $1,200. That's a 2014 number. I think it's 13 something now. I don't know exactly, but basically the credits are acquired quarterly, so you can get up to 4 per year. Pretty much anybody who's working is going to qualify for 4 credits, assuming that you're working more than like barely part-time. To be fully insured, which means that you would receive your maximum benefits, you have to have 40 credits, which essentially means that you have to work for 10 full years. So, Social Security income is indexed. The earnings are adjusted based on the consumer changes in the consumer price index. Your basic retirement benefit is what you're entitled to if you're fully insured. I'm pretty sure that number is somewhere in the neighborhood of $2,200 a month. It's not, in today's world, it's not a whole lot of money. It certainly wouldn't want to turn it down, but we need to think about other sources of income along with that. A lot of folks that have tried to live on the Social Security benefits alone, and they typically struggle quite a bit. The full benefit retirement age, 67 for anyone born after I believe it's at 1959. But anyway, it's 65 for those born prior to that. So, how you can choose how you want to receive your benefits. You can begin receiving the benefits at your full benefit age. You can begin receiving reduced benefits at a younger age. 62 is the earliest. You'll pay a penalty of 5% a year for each year up to if you begin receiving them at 62, I believe you would incur a 25% penalty. So you can also receive larger benefits if you wait till a later age, an age after your full benefit age. You need to check the accuracy of your Social Security statement, and the IRS mails these out on an annual basis. You can also go online and access your statement. You can look at them and see if you've been credited for all the income that you've earned over the years. It'll list your annual income and your credits for every year that you have worked. Now, like I said, online information, Social Security Administration makes this available. So you can see your earnings, your taxes paid, and then it also gives an estimated benefit amount. Concept check 17.1 summarize how workers become qualified for Social Security benefits. You earn a credit for each $1,320 that I looked up the 2018 number. So one credit for each $1,320, up to 4 in each year, and then you need to acquire a total of 40 credits to become fully insured. So distinguish between benefits, Social Security benefits provided to a worker who is fully insured and one that is currently insured. The fully insured workers and families are entitled to all Social Security benefits, retirement, disability, and so forth. Currently insured relates to the to death and disability claims. Otherwise you don't qualify for any of the others. But currently insured benefits retire a certain number of credits over effectively the last 3 to 4 years that the individual has worked. So the currently insured only applies in the event that the individual is not fully insured. Currently insured, as I mentioned, the qualification process is different. I believe we have to achieve 13 credits over that 3 to 4 year period. Concept check 17.1 explains what happens if you choose to retire earlier than your full retirement age, which in most cases is 67. If you were born prior to 1960, it's 65. Now, you're going to receive a lower monthly benefit. Your monthly benefit is reduced by 5% for each year where you retire early. If you were born after 1959, you will receive 75% of your benefit if you start at 62.